Hi, I'm Brett Warren. The more you know about the most common mistakes that property investors make, the better chance you have of avoiding them and growing your longer term wealth. In these weekly series, I talk to Michael Yardney about the common mistakes that we've seen. And today we're going to be talking about the idea that property never goes down in value. Michael, I know there's a lot of property spruikers out there that probably won't like to hear that, but what are your thoughts on that matter?
Well, you're right. There are people out there telling naive investors to buy property with the claim property values always keep rising. And the answer is no, that's not true. Every quarter, CoreLogic produces a pain and gain report, giving insights into the type of properties that are resold at a loss. And while the vast majority of properties in Australia deliver their owners a profit, a number of trends have emerged. Around 10% of all properties sold sell at a loss to their owners. The longer you hold your property, of course, the less likely this is to occur. But it doesn't mean that all properties go up in value. Some hold their values much more stably, but this year alone has shown how the tables can turn and external factors can affect property values. So over the long term, the trend for well-located properties is up, but in the short term, the property market moves in a cycle. Every downturn sets itself up for an upturn, but every time we have a good run, we've got to be prepared that property values will stall and in some instances slow down a bit, Brett.
So clearly there are some properties that do underperform, Michael. Tell us a little bit more about that.
Well, again, going to the CoreLogic Pain and Gain report, we found that apartments are more likely to sell at a loss than houses. And this is more likely due to investors buying new apartments and off the plan apartments. People often give the example that when you buy a new car and you take it out of the showroom, all of a sudden it loses value. But there's a number of reasons why new apartments and new homes in the outer suburbs house and land packages don't perform as well. While they're new and shiny and some come with rent guarantees and some come with depreciation allowances, all that is built into the initial cost of the apartment or new home and land package. And so is the developer's margin. And very, very frequently, so is the marketer's cost. So when investors get free advice from a so-called mentor or advisor, if they're not paying their fee for their advisor, they're the product. They're actually not getting a service looking after them. And so what's happening is that's already built in. And so therefore, if they were to sell it, one of the challenges with a lot of those new properties that are bought by investors is the depreciation doesn't follow on for an established apartment with the new rules. So even you go buy an apartment and you want to sell it in a couple of years' time, the pool of people buying it is much less, or somebody will pay considerably less for it because they don't get the depreciation allowance or the rental guarantees. So one of the reasons valuers on completion value apartments much lower than in the initial contract prices, because they know if it was to be resold, they couldn't ever achieve that price again. So interestingly, in Melbourne, apartments are 10 times more likely to resell at a loss than houses. Same in Brisbane, all those new towers and other areas as well. Similarly, regional properties tend to sell at a loss more than capital city properties, Brett.
We see that here as well. And obviously in places in Brisbane, like the CBD in the Valley, and in Sydney, there's Parramatta and Homebush and Zetland and those types of areas. So we are starting to see that, especially in the papers, it's starting to make the headlines where valuations in this different kind of time are coming in well under what people have paid. And it's causing issues in those inner city pockets.
The other area that's suffering is areas where people over this year in particular have had trouble with their jobs with COVID, but there's always areas where people are more likely to suffer from mortgage stress. These tend to be the outer suburbs or young families. They stretch their finance to get in. I know you did when you bought your first home. I did as well. All of a sudden, then people get themselves into financial trouble because they've gone to Harvey Norman or JB Hi-Fi and bought a whole lot of equipment or new furniture, and their 3-year interest period finishes up. They haven't learned the financial discipline. So I would be steering clear of areas where people are more likely to suffer financial stress, mortgage stress. That tends to be in the blue collar working areas or the new house suburbs, the outer suburbs, Brett.
Okay, Michael. So how do you buy the type of property that is more likely to be resilient and perhaps even grow in those periods and these periods at the moment?
Well, we use a top-down approach. So we first of all have a look at how the economy in a particular state's going. Then we only invest in the capital cities because they tend to have multiple pillars supporting their economy. Then within each city, we select suburbs that are less volatile because they've got more affluent owner occupiers and more people in those locations that have owned their house for 10, 20, 30 years and have paid off some, if not all, of their mortgage. They're the suburbs that during this time have been less volatile. But look at the GFC, look at the floods in Brisbane. There's always been certain suburbs that have been less volatile in pricing. These are the suburbs where more affluent people live. They've got more equity in their properties. And if somebody does have to sell, there's a line of people behind them ready to buy the property. So looking at the past history and performance of a suburb is important. We know location is critical. And then you've got to own the right sort of property that will appeal to a wide range of owner occupiers and also tenants, to mean that you'll have less likelihood of vacancies, or if ever you want to sell it, you'll be able to sell it quickly and have, as I said a moment ago, a line of people looking for it rather than long vacancies or long sale periods.
Thank you, Michael. I think we had some good context there about the do's and don'ts and what properties to look for and look out for, and I guess what type of people and for property spruikers to look out for as well. So if someone is saying to you that property never goes down, I'd be obviously very, very careful and perhaps take on some of those key points that Michael spoke about. And thanks again for your time, Michael. We'll catch you next time.
My pleasure, Brett.